Tonight we examine a digital commerce story shaped by global politics and shifting economic tides, a story that's quietly unfolding on millions of American smartphones. It begins with Temu's subtle but significant return to the US market, as the app once again appears in app stores and on home screens across the country. Temu, a platform famous for its rock-bottom prices and viral deals, is now cautiously selling a limited range of items directly to American consumers, reigniting interest among bargain hunters. This move marks a strategic reversal for the company, which had previously pulled back from direct-to-consumer sales in the US amid escalating trade tensions and regulatory uncertainty. Now, only a small fraction of Temu's vast product catalog is available, reflecting a cautious partial reopening as the company tests the waters and gauges consumer response. For small merchants in China, only select catalog items are reactivated, and Temu itself manages the entire transaction, from order to delivery, to ensure strict quality control and compliance with US standards. This full custody model is designed to guarantee a consistent and reliable user experience, as Temu carefully monitors every step of the process while re-establishing its presence in the US market. Previously, Temu had shifted to selling only goods already warehoused in the US, a strategic move to sidestep tariffs and avoid the uncertainties of international shipping and customs. By reintroducing a select number of direct-from-China goods, Temu is now balancing its core strength: direct access to manufacturers and low prices, with the risks of an unpredictable and often volatile trade environment. Company executives emphasize their ongoing commitment to price stability, reliable supply chains, and customer satisfaction as they navigate this complex adjustment period. Temu's latest move is a calculated adaptation, highlighting how global companies must remain nimble and responsive in a world where trade rules, consumer expectations, and market conditions can change overnight. Temu's move is a direct response to a temporary shift in US trade policy, a development that has sent ripples through the global business community. A brief reduction in tariffs on Chinese imports. This policy adjustment, though short-lived, has created a window of opportunity for companies that rely on cross-border trade. This trade truce offered a rare moment of relief for companies battered by the economic crossfire. For months, uncertainty and rising costs had weighed heavily on their operations, making even small victories feel significant. Before this, high tariffs had forced Temu and rivals like Shine to overhaul their business models, halting direct shipments and raising prices. Many businesses were forced to rethink logistics, renegotiate supplier contracts, and even cut jobs to stay afloat. The recent policy change signaled a possible de-escalation, prompting Temu to reconnect with American shoppers. This move was not just about restoring sales, but also about rebuilding trust and re-establishing supply chains that had been disrupted. These negotiations between Washington and Beijing are complex, with tariffs as a key bargaining chip. Behind closed doors, diplomats and trade officials weigh every concession, knowing that each decision can impact millions of jobs and billions in trade. For companies, every policy shift is scrutinized for its impact on operations. Executives must constantly monitor the news, adapt strategies, and prepare for sudden changes that could alter their market position overnight. The tariff reduction allowed businesses to recalibrate, even as uncertainty looms. Warehouses buzzed back to life and retailers cautiously increased orders, hoping the truce would last. Chinese tech firms like Temu are now betting that the benefits of re-engaging the US market outweigh the risks of another policy reversal. They are investing in new marketing campaigns, expanding logistics networks, and seeking innovative ways to serve American consumers. This flexibility, pivoting with geopolitical winds, has become essential for global companies. The ability to adapt quickly is now a core competitive advantage in international business. In today's world, business strategy and foreign policy are inseparable. Companies must navigate not only markets but also the shifting tides of international relations, making agility and foresight more important than ever. The sudden tariff reduction created a critical 90-day window of opportunity, an unexpected opening in an otherwise tense trade environment. For e-commerce giants Temu and Shein, this was a rare chance to act decisively and outmaneuver competitors. Tariffs on some Chinese imports dropped dramatically from a punishing 125% to a more manageable 30%. While still significant, this reduction made a huge difference for companies relying on cross-border trade. This allowed both companies to quickly restock their US warehouses, preparing for future sales surges, and insulating themselves from the risk of tariffs rising again. Previously, Shein had been forced to raise prices, and Temu had to halt direct shipments, with both companies scrambling to adapt to the rapidly changing landscape and avoid major losses. Now, with tariffs temporarily lower, both are ramping up bulk shipments to U.S. fulfillment centers, restoring a sense of normalcy and stability to their operations. For Shein, the ongoing trade war has also accelerated its ambitious plans to diversify manufacturing outside China, a massive long-term undertaking that requires building new supply chains and partnerships across Southeast Asia and beyond. This dual strategy, restocking inventory now while simultaneously diversifying for the future, demonstrates how these companies must operate in a state of constant flux, always ready to pivot. The old way of doing business, relying on predictable trade policies, is gone. Future success depends on anticipating and adapting to geopolitical shifts before they happen. In this new era, only the most adaptable and forward-thinking companies will thrive, turning uncertainty into opportunity. The US-China trade war's uncertainty has rattled American businesses far beyond e-commerce. Small business owners face paralyzing unpredictability, making long-term planning nearly impossible. Some have even sued the government over the financial burdens of tariffs. Major corporations, from Walmart to Microsoft, have announced layoffs in response to rising costs and uncertainty. National economic data shows a sharp drop in U.S. imports, rippling through ports, trucking, and retail. CFOs across industries are hesitant to invest or hire, stifling innovation and growth. The core issue: unpredictability. Businesses can adapt to new rules, but not to rules that change without warning. This instability complicates everything from inventory to financial planning. Companies of all sizes are forced to navigate a treacherous, ever-shifting landscape. Tariffs and trade uncertainty ultimately hit American consumers hardest. Companies facing higher import costs are raising prices to protect profits. Shoppers see higher price tags on everything from electronics to clothing, fueling inflation. Supply chain disruptions also threaten product shortages, especially for goods reliant on Chinese manufacturing. Imagine searching for a holiday toy or gadget only to find empty shelves. Families are squeezed between rising costs and potential unavailability of essentials. Lower and middle-income households feel the pinch most. The trade war, once a distant headline, now shapes everyday purchasing decisions. A drop in imports slows the entire economy, affecting jobs in logistics, retail, and manufacturing. Consumers are left paying more for less, in a marketplace that feels increasingly unpredictable. In this volatile trade environment, corporate America is playing defense. The focus has shifted from growth to survival, with layoffs sweeping across major sectors. Companies are also raising prices to offset higher costs from tariffs, risking a drop in consumer demand. This balancing act, absorbing costs or passing them on, reflects deep uncertainty. CFOs warn that erratic trade policy makes forecasting and long-term planning nearly impossible. The result: delayed investments, hiring freezes, and a slowdown in innovation. Businesses are paralyzed by unpredictability, adopting a risk-averse stance. This caution ripples through the economy, dampening productivity and expansion. Corporate America is in a holding pattern, waiting for policy clarity. Until then, bold investments and growth remain on hold. Despite tariff pressure, most large U.S. companies haven't shifted sourcing away from China. Reshoring remains more political slogan than business reality. Changing suppliers is costly and complex. Decades of building global supply chains can't be undone overnight. Companies prefer to optimize current operations, negotiating better terms or passing costs to consumers. Moving factories or switching suppliers impacts design, quality, and timelines. U.S. manufacturing capacity simply isn't there. Rebuilding would require massive investment with no guarantee of policy stability. So, businesses stick with what they know, focusing on efficiency and resilience. They scrutinize supply chains, cut waste, and use data to offset tariff costs. The strategy is adaptation, not revolution, reflecting the realities of a deeply interconnected world. For now, operational efficiency is the name of the game. While most companies optimize existing supply chains, Shein is taking a bold, forward-looking approach. The fast fashion giant is expanding manufacturing to countries like Brazil and Mexico, reducing reliance on China. This diversification is a long-term play to weather future trade disputes. By building regional hubs, Shine creates a flexible, resilient supply chain that can shift production as needed. It's a fundamental re-engineering of global operations, not just a minor tweak. While most companies play defense, Shane is playing offense, redesigning for a new era of global trade. This could become a blueprint for other multinationals facing geopolitical risk. Shane's global expansion is a case study in corporate adaptation, investing now for future stability. By spreading risk, Shine positions itself as an agile, durable player in international e-commerce. Temu and Shine's recent moves reveal the new reality of global commerce. Flexibility is everything. Success now depends on adapting to constant change, not just price or product. Temu's cautious return and Shane's global pivot are calculated strategies for a volatile world. Economic data, falling imports, layoffs, uncertainty, shows the real impact of unstable trade policy. Businesses delay investments and hiring, stalling growth. The only certainty is more uncertainty. Companies must stay vigilant and agile. Flexibility is no longer a competitive edge, it's a survival requirement. In the 21st century marketplace, resilience and adaptability are the true currencies of success.